The US government debt market is on the verge of breaking. Foreign central banks have started to dump their US Treasury bond holdings at a pace that's never been seen before. These foreign institutions held nearly $3.2 trillion worth of US Treasuries at their peak back in 2021, which is roughly the same size as the entire GDP of France, but their holdings have now fallen to just $2.7 trillion. And this selling of US Treasuries has only been showing signs of accelerating in the recent weeks. US Treasury bond prices have already fallen by 45% since 2021, largely coinciding with this selling by foreign institutions. As they say, the hand that lends rules the hand that borrows, and that's exactly what seems to be happening. If these foreign central banks continue to sell at the pace that they've been, we could be at risk of seeing another large move down for the US Treasury bond market. This is a $31 trillion market that we're talking about that's larger than the stock market of China, Japan, and the UK combined. US Treasuries are the foundation of the entire global financial system. They are used as collateral by international banks, they are used as a benchmark for every borrowing rate in the global economy, and they've been used as the world's primary safe haven asset for decades now. So a collapse of this market would have catastrophic consequences not just for the US, but for the entire world. Now, just like other financial assets, US Treasuries are primarily influenced by two factors: supply and demand. If demand outweighs supply, prices will go up. And if supply outweighs demand, prices will go down. So if foreign institutions no longer trust the US government's debt, firstly, that reduces demand because they stop buying any new US debt, but it also increases supply when they sell treasuries that they own. That's essentially what's been taking place today. Now, the big problem here is that this has been happening at the very same time as the US government has been increasing its supply of US treasuries like never before by issuing a record amount of US debt. We can see that from these two lines that have been diverging from each other more and more in recent years. This line shows us the total revenue that the US government brings in from things like income taxes, corporate taxes, and tariffs. And this other line tracks the total amount that the US government spends on things like social security, healthcare, defense, and interest payments on the debt. We can see that until about 2008, these two lines remained relatively close to each other. The government was generating enough revenue to broadly keep up with what it was spending. But since 2008, spending has consistently been outpacing revenue. And since the pandemic, the government has been overspending by at least $1 trillion every single year. By the way, this is also around when foreign central banks started to sell their US treasuries as they began to question the US government's spending habits. Today, government revenues sit at around $9 trillion, where spending has risen to $10.8 trillion. This $1.8 trillion gap is what's known as the government's deficit. And to cover this deficit, the government has only one realistic option: it needs to borrow money. And it does this by issuing treasury bonds to banks, individual, institutional investors, and foreign governments. Now, this spending problem is likely only to get worse from here. The government is currently spending around $2 billion per day on the war in the Middle East, and is only projected to further ramp up its spending on defense as geopolitical tensions have been rising. All of this significantly increases the supply of US treasuries that are hitting the market. So in other words, in 2026, we already have a massive deficit that's likely to only get worse. And at the same time, one of the biggest holders of US debt, foreign governments, have been offloading their treasuries. So you have both an oversupply of treasuries and weakening demand for US treasuries. Theoretically, that should mean that treasury bond prices should go down. Now, you might be wondering, US treasury bonds have already declined by 45% since 2021. So how do we know that all of these concerns that we've talked about are not already priced in, and that prices are so low that demand can only start picking back up from here? Well, just like any other investment, the demand for US treasuries ultimately comes down to one thing: whether the return on investment is high enough to justify the risk of owning them. A simple way to look at this is by breaking down the 10-year treasury yield into its two key components. The first is the average short-term interest rate that investors expect over the next 10 years. Now, that may sound complicated, but this is is essentially primarily set by the Federal Reserve, which has a direct control over where short-term interest rates go. The second component is what's called the term premium. This is the extra yield that investors demand from the government to compensate them for any additional risk that could materialize in a 10-year holding period. Things like inflation, geopolitical instability, any unexpected shift in government policy. You can think of the term premium like an insurance premium. The riskier the environment, the more compensation investors demand before they are willing to lend their money to the US government for a decade. And this is what it looks like. When the term premium is high, investors consider bonds risky and so demand a higher yield to own them. When this is low, it means investors perceive the risk of Treasury bonds to be low and so they don't ask for much extra compensation. Now, throughout history, the term premium has generally stayed between 2 and 3%. Today, the term premium sits at only 1%. This means that holders of US Treasuries are not being well compensated for the risk of holding them. We actually think that the term premium would need to rise closer to 2.5%, which is actually the 60-year historical average, before we can say that Treasury bonds truly reflect most of the risks that we highlighted in this video. This kind of move on the term premium would mechanically push up the 10-year Treasury yield from 4.5% today all the way to 6%. What would that mean for Treasury bond prices? Well, for every 1% rise in Treasury yields, bond prices tend to fall by 15%. So in other words, a 1.5% rise in Treasury yields from here could lead to another 20 or 25% decline in Treasury bond prices, which would have potentially devastating consequences for the broader economy. As we mentioned earlier, US government bond yields are the benchmark for every borrowing rate in the economy. So higher Treasury bond yields would mean higher borrowing costs for businesses, making it more expensive for them to invest, expand, and hire workers. But it would also mean higher mortgage rates and higher credit card rates, both of which would squeeze household budgets and reduce consumer spending. If this actually happens, it would start to put significant pressure on the US economy and could eventually tip it into a recession, as we have seen in prior instances where Treasury bond yields have risen. But before you panic sell all your stocks and start hoarding cash, it's important to remember that cash is a form of US Treasury bonds. And typically in these kinds of environments, cash loses purchasing power at a very fast pace. History shows that the stock market can actually often do quite well when Treasury bond yields are rising. We can see that's what happened between 2003 and 2007, between 1998 and 2000, and on multiple occasions throughout the 1970s. It's only once Treasury bond yields rise high enough to actually break the economy and trigger an economic recession that stocks can experience volatility. So from where we are standing, there's still an imminent risk of holding Treasury bonds or cash, while the risk of holding the stock market is a lot more nuanced. Our job as investors is to always calculate the risk and reward of being in the market versus not being in the market. We want to maximize our returns when the economic backdrop and momentum is strong and move to protect capital before the risk of a major drawdown materializes. This is exactly what we built our quant model to actually do by signaling when to go leveraged long on the stock market and when to flip to cash. Over the last 5 years, the model has provided a 468% return, which completely crushes the S&P 500's performance, and it continues to work up until this very day, as it has made already a 30% return just in 2026.